Since the beginning of civilization, empires have rarely fallen overnight. Nations did not disappear because of a single battle. The true collapse almost always began silently, inside treasuries and markets. When money lost its value, trust disappeared, and fear replaced confidence. Every major financial collapse did more than destroy economies. It reshaped history itself. The first collapse occurred in ancient Rome. During the final centuries of the empire, expansion became more expensive than the state could afford. Instead of increasing productivity, emperors chose a dangerous solution. They reduced the gold and silver content of Roman coins while producing more of them. Each new coin carried less real value. Prices surged, wages collapsed, and soldiers refused to fight for money that could no longer feed their families. Rome was not defeated by invaders alone, it was financially exhausted from within. The second collapse struck Europe in the 14th century during the failure of the great Italian banking houses. Cities like Florence and Venice had become the financial centers of the known world. Kings and empires depended heavily on their loans. When several monarchs defaulted on massive debts, the largest banks of the era collapsed within a few years. Trade froze, fortunes vanished, and Europe entered a prolonged economic slowdown that altered its commercial future for generations. The third collapse was the most famous in modern history, the Great Depression of 1929. During the Roaring Twenties, Americans believed prosperity was endless. Millions borrowed money to invest in the stock market, convinced prices would rise forever. When the market crashed, wealth evaporated overnight. Banks failed, businesses closed, and unemployment spread across entire nations. The crisis was not merely economic. It destabilized societies, fueled political extremism, and laid the groundwork for the Second World War. The fourth collapse occurred in Asia in 1997. Countries such as Thailand, Indonesia, and South Korea were celebrated as economic miracles. Rapid growth attracted massive foreign investment, much of it based on short-term debt. When investor confidence suddenly vanished, capital fled within days. Currencies collapsed, companies went bankrupt, and millions were pushed into poverty. The Asian financial crisis revealed how quickly global markets could destroy national economies. The fifth collapse came in 2008 with the global financial crisis. Major banks issued enormous volumes of loans to borrowers unable to repay them. These risky debts were repackaged into complex financial products and sold worldwide. When homeowners began defaulting, the illusion shattered. Financial institutions that had existed for centuries collapsed within weeks. Governments were forced to rescue banks using public money, while ordinary citizens paid the price through unemployment, lost savings, and economic stagnation. From that moment forward, global trust in the financial system was permanently damaged. What unites these 5 collapses is not geography or time, but a repeating pattern. Excessive expansion, rising debt, blind optimism, and finally sudden panic. History teaches a brutal lesson. When money becomes detached from reality, collapse is inevitable. The only uncertainty is not whether another financial crisis will come, but when it will arrive, and who will bear the cost when it does.